Good morning. It's March 24th, 2023, and we're going to be talking about fundamentals today. I know I don't always show you the data on fundamentals because I assume that that's what you're doing, but let's dive into a topic that I was talking about on Real Vision with Maggie yesterday about how dividends may be cut, and same with share repurchases. We're actually going to go over not to the Longbow dashboard, to my S&P Cap IQ dashboard. So let's head over there now. And this shows the cash flow statement of CDW. I don't have a dog in this hunt, but this is a name that I wanted to show you of why it's important to look at cash flow, especially for a business that may be considering bringing back its share repurchases, and one that also often has a dividend. So if you look at the net income line here, and this is from 2017 to 2022, so these are annual figures, you can see an increase in the net income of the company. They add back depreciation and amortization, goodwill and tangibles, and then it goes to basically the working capital section, so that you get cash from operations. That's operating cash flow. And as you can see, back in 2017, almost 780 million, 900 million, you've got over $1 billion. In 2021, it was less, and that's because there's a big, there's inventory that's sucked up. And then you've got here, $1.3 billion. So we're moving from net income, looking at net income, this was called roughly billion of 2021, and then cash from ops of 780. Here we've got over $1 billion, and then even more in the cash from ops, which tends to be what you see the historical pattern for, is that the cash from operations is a bit higher than the net income. You like that. You want it, what you want to have is net income translating into cash flow, not the opposite, where it gets sucked up into working capital and you're not really getting the benefit of cash flow. We can see that they do CapEx, but they're pretty minimal here. Obviously, they've done some acquisitions and other things, but you can also see what they've been doing with that cash flow. Really important. They've been paying down debt over time. Shareholders love that. So you definitely have enough cash flow to keep paying down debt. The same thing here, dividends paid. You can see that they've been paying dividends over time, and those dividends have been increasing. So if you're concerned about a recession, you're concerned about a market decline, of course, IT spend, that's what's one of the key drivers of CDW, would soften. But if you're looking for a way to get paid back, you can see that they do pay their dividends to shareholders. And the same thing you can see in terms of share repurchases. So they've repurchased shares every year. They halted last year, but then they said they were going to come out and do a 750 billion coming up here. So it means, yes, they have cash flow. It's significant. It's more than net income, and it can cover its debt repayment, its dividends, its share repurchases. That's what I was talking about on Real Vision and what we were mentioning in the note before that. And it echoes to something that Goldman Sachs was talking about today, where their desk is saying, gosh, share repurchases are down. We think that that's going to happen even more so. That's going to be an increasing pattern this year in 2023. So as you're doing your fundamental work, hopefully you can mirror what we just did to take a look at if a company is able to do, again, the things that it needs to do to please shareholders, which is hopefully grow or at least tread water a little bit. 2, get that net income into cash flow. And then 3, do the things you want it to do, whether it's paying down debt, paying dividends, doing share purchases, so that amount can cover all of that it needs to do to make shareholders happy. That's it for today. If you have any questions, just let us know, and we'll see you back on Monday.